Hey, what's up, everyone? Welcome back to my world of stocks. Now, given the spooky season of Halloween, I thought it'd be fun to do a video on one of the most mysterious indicators in the market. A very interesting one, though, called the Halloween effect, which basically states that the market will rise much higher in the months following Halloween. And there's actually some very strong data to back this up, too. So, given that the market has been breaking new record highs. I think this should be pretty interesting to look at here and see if, maybe we're in store for even bigger gains to come soon in the coming months. Well, let's dive into it here. We'll start first with what the Halloween effect even is. We'll look at all the historical evidence for it, and then I'll even apply some of that data to our current situation. I'll let you know what I'm doing myself as a long-term investor. I'll give you my overall opinion on all of this too. By the way, I was a little sick recently. That's why I haven't been uploading as much, but I'm going to have more videos coming for you guys very soon. So make sure you're subscribed. We'll have a lot of fun together. But this coming straight here from Investopedia, looking at the Halloween effect, the definition for it states that the Halloween strategy, effect, or indicator is a market timing strategy based on the hypothesis that stocks perform better from October 31st or Halloween to May 1st than they do from the beginning of May through the end of October. And that you should, basically sell all of your stocks in April to avoid the summer months. That's basically what it's saying here as well, if you read a little further. So, for example, let's say you were to buy stocks in November, you hold them through all of the winter months, and then you sell the stocks sometime around April, then you should most likely see much better performance than any other time periods throughout the year. Broadly speaking, of course, at least in the sense of like that half of the year versus the other. And by the way, this also coincides with another popular belief or trend that many short-term traders and especially swing traders like to practice. It's called sell in May and stay away. You've probably heard of it, where, again, you're basically just trying to avoid the summer months. So the Halloween effect is basically just the inverse of that, where you make sure to buy around Halloween time and then you sell again around April and May. Now, I will show you the facts and historical data to back up these theories in just a second here, and it is pretty fascinating stuff. But what would even cause such a strange phenomenon like this to even happen in the first place? Why would the market perform better or worse during certain months? Well, there's no real definitive explanation that we can point to with total, complete certainty, which is why the Halloween effect has always been a little mysterious. However, there are a few ideas or hypotheses that may have something to do with wealthy elites, the ones that really drive the market, often taking their vacations around summertime and thus exiting the stock market. While on the flip side, around the winter months, we have the big holiday shopping season where money, of course, pours into all of these public companies who, at the same time, too, are trying to use up their end of year budgets while also spending even more money on advertising because of the holiday shopping rush where they compete with rivals to attract customers. Regardless of how accurate any of these assumptions are, though, what we do know is that historically speaking, it is very much a pattern that we can actually measure within the stock market. And here's the data on that. It's kind of crazy. Now, just so you know, most analytical sites use the past 3.5 decades or so, basically going back to 1990, as it best reflects the current structure of markets, especially after the rise of institutional investing, ETFs, digital trading, and of course, more modern economic policy. And so I had Copilot using ChatGPT 5 pull this data up from Yahoo Finance, investing.com, and Macro Trends, where it showed that a whopping 83% of the time since then, since 1990, the October to May period gave back positive gains for the S&P 500, 83% of the time. And on average, it saw nearly a 7% rise, while the opposite period, May to October, only rose about 2% instead. In other words, the Halloween effect, again, on average, saw 3.3 times better performance than the other half of the year. And that's pretty freaking crazy. I mean, if you can get more than 3 times better returns on your investments during one half of the year versus the other, obviously that's going to translate to, way better performance in your portfolio and your overall investments. Now, having said that, does it mean that we should just go ham during these months right now and then, sell everything around April and May and stay away from stocks? Well, no, I don't personally think that. Now, don't get me wrong, this is a fun metric to look at, and even I myself sometimes enjoy looking at these type of indicators just to be aware of trends and what may be more likely to come in the future, just be, aware of it. But I am still very much a firm believer of time in the market rather than timing the market, because even though trends have happened in the past, on average, it doesn't mean that they'll repeat every single time moving forward, nor does it change my overall goals and strategy for what I'm trying to accomplish with stocks. Now, if I was a swing trader or a short term trader, then yeah, of course, I'd be paying much closer attention to all of these sorts of trends and analytics to try to find the absolute best times to buy and sell a stock. But I'm just not a very big believer in that. I feel that holding stocks for many years will almost always generate much bigger returns than the little, single digit rises that we see in the market during specific time periods like the ones we're looking at today. And whenever I show you guys my personal positions, a lot of times viewers are often shocked that I'm up sometimes thousands of percent on some of my individual stock positions. But the reason for that is because of two things: buying much heavier on the dips and also holding on to those positions and sometimes even adding to them over many years for the long term into the distant future, which is something that the Halloween effect or the sell in May and stay away strategies don't really apply to, nor do they take into account the randomness that can occur in the market. Take 2020, for example. If you bought near the top at the end of 2019 and then you sold, following the Halloween effect, and then you sold all of your stocks around March, April, or May, when the market had suffered one of the sharpest crashes in history, well, not only would you have lost an unbelievable amount of money, but you would have also missed one of the biggest recovery rallies ever throughout the rest of the year because you chose to stay away. Well, instead of doing that, I actually went ham on stocks during that crash, where I also put out tons of videos explaining why it was such a great time to be buying stocks on the giant crash, on the big dips, which I actually got a lot of criticism for, by the way, mostly from the short term trading community, people that just always seem to be a bit too afraid to buy stocks when they're actually going down in price because of how, in my opinion, they're very pessimistic about the future, and they're always just kind of panicking and focusing on short-term movements rather than focusing on the long-term picture, where ever since that crash, for example, my stocks ended up skyrocketing from those lows, where I'm now enjoying the rewards of it longer term. And even, by the way, I'm also collecting some huge dividends on a lot of those stocks too, because of the lower cost basis that I got on them. Plus, if we apply the Halloween effect to our current situation today, one that is riddled with macroeconomic uncertainties like trade wars and tariffs and the rise of AI and high inflation, high interest rates, all likely fluctuating and evolving in the coming months, well, I'm just not sure that a traditional indicator or trend that is based so heavily on sentiment will actually prove to be true when the stock market is already breaking new record highs, with, by the way, also the Shiller P ratio sitting right now at one of the highest levels in history. In my personal opinion, and not that that really matters too much, by the way, but just in my opinion, sharing it with you, I think that we're probably going to see a lot more volatility than we're probably expecting. But again, that is a good thing. Prices being volatile and ideally, hopefully, going down would actually be a good thing, so long as you remain calm, you prepare correctly for it, meaning you have a stable job, you focus on your career and make sure you have reliable income, but you also have savings, you diversify your portfolio, you do all those necessary things, then you should welcome that volatility, because it'll give you your best opportunities to go out there and find even better deals than you thought was even possible on your favorite stocks. So again, I invest in any season, but I also invest much heavier during downturns too, most of which is with a very long-term mindset of sound fundamental investing. But hey, those are just my thoughts on all of this. I'd love to hear yours down below too. Let me know what type of investor or trader you are. Let me know if these indicators are something that you ever keep track of, or if it's something that you just don't really pay much attention to. Either way, I hope you enjoyed the video, and I thank you so much for your support. Thank you for stopping by. I hope you all have a safe Halloween and upcoming holiday seasons, and hope you're all doing well, my friends, and I will catch you in the next video. All right, take care, everybody. Bye-bye.